The psychology of markets, how human emotion shapes the global financial system. For all the technology, mathematics, and machinery that define modern finance, the global economy is still built on something far older, far more fragile, and far more unpredictable: human emotion. Fear, confidence, arrogance, instinct, panic, hope. These forces shape markets as powerfully as any algorithm or economic policy. Behind every price movement is a human mind reacting to the world. Behind every crash is a moment of collective fear. Behind every rally is a wave of belief strong enough to move billions. Finance is not just numbers on a screen. It is human psychology, scaled to the size of nations. When you strip away the complexity, markets are simply mirrors, reflecting how humanity feels about the future. A bond sell-off may begin with a whisper of uncertainty. A currency rally may start with a spark of enthusiasm. A crash may ignite from nothing more than a rumor spreading faster than fact. The city of London, for all its sophistication, is still driven by the same emotional currents that moved markets centuries ago. The difference is scale. Today, a single moment of collective panic can wipe out trillions in seconds. Every day, inside the towers of the city, decisions are made by people who believe they are rational, disciplined, immune to emotion. But beneath the surface, psychology governs everything. Traders feel pressure to act before others do. Analysts fear missing a signal. Executives fear being wrong. Regulators fear being late. Investors fear being alone. Fear and confidence dance together, guiding the flow of capital through the global system. It is no coincidence that markets often peak when investors feel invincible and collapse when they feel exposed. Fear is the oldest force in finance. It drives sell-offs, motivates hedges, and pushes money into safe havens. When uncertainty rises, during elections, wars, pandemics, or scandals, capital flees to places where it believes it will be protected. Gold, bonds, the dollar, the franc, and sometimes London itself become emotional shelters. This is not strategy. It is instinct. Even the most advanced quantitative systems incorporate fear indirectly because their inputs include the behaviors of frightened humans. Confidence, on the other hand, builds markets. It fuels investment, risk-taking, expansion, and innovation. Confidence is a foundation on which entire financial systems stand. Without it, no bank could lend, no investor could buy, no economy could grow. Confidence is fragile, slow to build, easy to break. When people trust in the future, markets rise. When they doubt, everything becomes unstable. Between fear and confidence lies greed, the force that pushes markets beyond rationality. Greed creates bubbles, drives speculative mania, and convinces people that the impossible is possible. It seduces investors into believing that prices only move upward. History is filled with such illusions. The South Sea bubble, the dot-com boom, the housing market frenzy, all were fueled by the same psychological trap. Confidence becomes greed. Greed becomes belief. Belief becomes blindness. And then the fall begins. Panic is the moment when emotion overwhelms reason completely. It spreads with the speed of contagion. One trader sells out of caution. Another sees the move and follows. Algorithms detect volatility and accelerate the decline. Within minutes, a small spark becomes a firestorm. Markets collapse not because of logic, but because humans behave like herds under stress. The city has seen these moments many times. Black Monday, the financial crisis, flash crashes that appear and vanish in seconds. Panic is as old as finance itself, but in the age of digital markets, its power is amplified. Another force shaping markets is loss aversion, the tendency for humans to fear losses far more than they value gains. This psychological imbalance can distort entire strategies. Investors hold losing positions for too long, hoping for recovery, while selling winning positions too early, fearing they might disappear. Loss aversion shapes everything from pension decisions to major institutional strategies. Many of the world's largest funds are structured not for maximum profit, but for minimum regret. But markets are not only shaped by individual emotion, they are shaped by collective narratives. Stories move markets more than spreadsheets ever will. A rumor about interest rates, a belief in technological transformation, a fear of recession, a story about a company's future. These narratives can move billions. Traders do not just trade data. They trade stories about what the data means. The city is full of these stories whispered in hallways, typed in notes, repeated in meetings, amplified by analysts, and transformed into action by investors. Herd behavior is another psychological engine behind finance. When investors do not know what to do, they look to others. They follow trends because trends feel safe. They join the herd because the herd appears wise. But herds are dangerous. They move too fast, think too little, and magnify every mistake. The dot-com frenzy was herd behavior. The 2008 crisis was herd behavior. And in the age of social media, herds form faster than ever. A single viral post can move markets. A coordinated message can spark buying frenzies or mass sell-offs. The modern herd is digital, global, and instantaneous. Anchoring also shapes decisions. The human tendency to rely heavily on the first piece of information they receive. A target price becomes an anchor. A previous high becomes an anchor. A psychological threshold, like a round number, becomes a barrier that investors believe has meaning even when it has none. These mental anchors influence decisions across the city every day, often without the decision makers realizing it. Overconfidence is perhaps the most dangerous psychological force of all. Many investors believe they are smarter than the market. They believe they can see patterns others cannot. They believe they understand risks that others misjudge. Overconfidence fuels bold trades, risky strategies, and untested ideas. Sometimes it leads to breakthroughs. More often, it leads to losses. Entire institutions have collapsed because of a single individual's overconfidence. Entire markets have crashed because too many people believe they were invincible at the same time. Yet for all the rationality, the psychological foundation of finance also creates opportunity. Human emotion introduces inefficiency into markets, and inefficiency creates potential. When investors panic, others can buy. When narratives exaggerate fear, others can find value. When overconfidence inflates prices, disciplined investors can prepare for the correction. Emotion is not only a risk, it is a force that shapes cycles, creates momentum, and fuels the dynamism of global finance. The City of London has always been a theater of human psychology. Traders, bankers, analysts, and investors all believe they are acting rationally, but every decision they make is influenced by the wiring of the human brain. The global financial system is a reflection of the human mind, brilliant, creative, fearful, hopeful, and deeply imperfect. The machine's amplifying system may reduce emotional noise, but they cannot eliminate it. They simply process it faster. In the next 50 years, psychology will matter more than ever. As technology accelerates, the emotional reactions of humanity may become the only unpredictable element left in the market. And as long as humans remain part of the system, markets will rise and fall not only on data, but on emotion. The next episode of Cinematic London Finance Chronicles will explore the invisible power brokers of the modern era. The rating agencies, standard setters, and global evaluators who influence markets more quietly, yet more decisively than governments themselves. Subscribe and continue the journey into the unseen forces shaping our world.